Good morning, good afternoon, good evening, wherever you are listening to me. Welcome to another episode of Wealth Building Conference. My name is Oludare Fasola. On behalf of Wealth Building Conference team, I want to thank everyone who has been joining us for the past couple of months that we started this program. I'm super excited to be here today and to also say Happy New Month to you. We are moving towards the end of the year. I want you to please reflect back and ask yourself, what are you grateful for? If you are not grateful for anything else, please be thankful for the gift of life. Many people are in the hospital today. Many are, for one reason or the other. We just have to be thankful to God. We need to have the art of gratitude. That's one thing I also want to say before we go into the presentation today. But it is very important to have that heart of gratitude, because when you are grateful to God, you are asking for more, right? Ask don't think of what you have not really achieved. Think about what you have been able to do from January till today, right? It has been God all the way. We want to thank everyone. I want to be thankful to God for giving us another opportunity to be here today. So wherever you are joining us, I want you to please do me a favor. Type your name and where you are joining from. Please type your name and where you are joining from. For example, if you are joining from Canada, please type your name and put Canada. If you are joining from United States or any part of the world, I want you to please type your name and where you are joining from. And I want this presentation to be engaging. I don't just want to talk, right? Please, if you have any question, drop it in the comment section. We're going to attend to your question before after the at the end of the program. But the goal is to educate ourselves on how to build wealth, especially for medical professionals and business owners. Once again, I want to say thank you so much for those that joined. And for those of you who have just, that are joining, I want you to grab your pen. We're going to learn a lot today on how to use life insurance to build tax efficient wealth as a medical professionals and business owner. I'm Oludare Fasola, your regular host. I'm so excited to be here today. Whether you are just turning from your clinic, your office, or your comfort of your home, this session was actually created specifically for you as a medical professional and business owner. All right. And a lot of times we work so hard, but our money is not working hard for us. So you need to understand how you can save as much as you can in this country. I used to say it every time, not how much you make, but how much you can actually save. That is the goal here. Again, when it comes to life insurance, most of the times people actually look at life insurance as a strategy just to protect our life and just to pay out death benefit to any time pass. But life insurance is actually more than that. All right, it's just the type of life insurance that you actually have that will determine what the benefit and advantages for you as a medical professionals and business owner. So I want you to please pay attention. Tonight, we're going to pull back to the curtain on the strategies that the well advisors have used for decades on how to turn your insurance policy into a powerful tax shelter, wealth engine, and generational legacy tools. And you will also discover how to legally reduce tax using corporate life insurance strategy. Again, build liquid, accessible cash value inside your policy and create a retirement ready structures that keeps your wealth compounding efficiently. And most importantly, protect your loved ones while you build long-term freedom. This is not about just selling a product. It's about showing how you think like an architect of your own financial future. So grab your notebook, clear your distractions, and lean in, because what we're about to cover could literally change everything for you. Because I've seen many people, they make so much money but they have nothing to show for it. The way you think about money, taxes, and wealth forever. By the end of this session today, you will see exactly how right insurance structures can help you keep more of what you earn and make your money work harder that you do. So let's dive in and unlock the blueprint to building tax efficient wealth the smarter, safer, and more sustainable way. Once again, welcome to the sessions. I'm truly honored to be here today. My name is Oludare Fasola. Let's dive into the presentation. Let me quickly pull up my slide, so that we can quickly go in. Let me quickly pull up my slide. Tonight, we're going to be looking at how life insurance, how to use life insurance to build tax efficient wealth as a medical professional. One thing I've noticed about these strategies, and what I've noticed so much in this country, is that people earn so much, but at the end of the day, they have nothing to show for it. I have been I was I went to go and meet my client one day, and when I entered his office, I don't like today because I just pay CRA. I think I've said it earlier. And the reason why he's not really happy is because I can save more of what I earn than to give this so much on taxes. And this is what is actually happening to a lot of people today, right? You earn so much, but you have nothing to show for it. And in this part of the world, like, the more you earn, the more tax you pay. Is progressive tax. The more you earn, the more you pay. So, but you want to make sure that at least whatever you earn, you keep more of that. But before we go into the presentation, let me quickly make a disclaimer that this presentation is for educational purposes only and does not constitute financial, tax, or legal advice. Always consult with a licensed professional before implementing any financial strategies. Product illustrations and results may vary by individual situation and jurisdiction. Okay, so please take note of that. All right. Now let's look at why are we here today. Why are we here today? Number one, strategic wealth tools. So understand how life insurance go beyond death benefit to become a powerful wealth building instrument. Many times, many people think that, oh, life insurance is, if I get life insurance, what I will just get at the end of the day, if I pass, my family will get paid. Of course, that's one of the benefits of life insurance policy, but it all depends on the kind of life insurance you get. Like, there's what we call death insurance. There's what we call, cash value life insurance. So if you have a kind of insurance that pay you when you pass, of course, it is what it is. That is that's what you get. And I'm sure a lot of people do not know that there are other type of insurance that will actually pay you while you are alive. Not only that, that will even give you immediate access to money, like liquidity, right? Expanding of your clinic, retirement planning, going to other form of investment strategies, which I'm going to share today, right? Number two, learn how to structure policy for maximum tax efficiency, growth, and protection. So life insurance is one of the very powerful tools to save on taxes. And I'm going to show you typical example of that as we proceed in this presentation. But you know what? It all depends on who actually structured this life insurance for you and what's your goal, right? It's very important. Discover proven strategies that help Canadians, medical professionals, preserve and grow wealth, right? That is why we're here today. Now, let me ask you, you work hard, but you pay more taxes than you should. Like, if you're a medical professional today joining this session, I want you to drop in the comment section, how much tax did you pay last year? And after this session, right, if you implement all of this, and next year, and you check how much tax you're going to pay next year, because this is what I've been using for many medical professionals, and it's actually working for them. Trust me. Medical professionals face unique financial challenges that traditional planning often overlook. Number one, high tax exposure. High income automatically means high tax burden with limited relief options. Let me tell you this, right? I was actually working with a medical professional, so we're analyzing it. I say, doctor, do you know how much tax you pay? Say, look, well, I pay 12% on my corporation, so he's in Ontario here. And I said, did you pay yourself salary? He said, yes. Do you know how much you pay, taxes you pay if you pay yourself salary? He said, well, depending on your tax bracket, you could pay up to about 30% if you pay yourself salary. All right. Now, your corporation tax again is about 12%. So if you add 12 plus 13, that's going to about 40%. Now, What about your retained earning as well? So at the end of the year, they do your profit and loss, and you make profit and you reinvest that profit, and you make more than 50,000 on those investments, you pay up to 50%. And he paused and he said, this country is crazy. Like, people are paying taxes without. Don't forget, you also pay tax on your grocery, you pay tax on your gas, pay tax on virtually everything. Why would you continue to pay tax, and tax? Because why? I don't have strategies to save as much as you can on taxes is acceptable by CRA, right? Number two, fewer deductions, opportunities, and restricted retirement plan options compared to other professionals. You are a business owner. You must make plans. You must plan for your retirement. And honestly speaking, your accountant cannot do that for you. That's what I want you to know. Because a lot of times we rely so much on accountant. Oh, I've met a lot of medical professionals and business owners, and when I, run illustration with them, and they say, "No, Mr. Fashola, let me speak to my accountant." Of course, you need to speak to your accountant, but do you know that your accountant cannot build wealth for you? Your accountant cannot help you. They cannot build. They cannot help you with your retirement planning. I will be the one to do that for you. Your accountant can help you to prepare your books of account and prepare your balance. Not help you to plan for your retirement. So you, as a medical professionals, you must have various options to plan for retirement. And what I hear from many medical professionals most often is that I'm doing real estate. Well, it's good, but what happened in the real estate market in the last 3-4 years in Canada is crazy. Like, people lose a lot of money. People lose a lot of money. If you are a medical professionals or business owners and you are planning your retirement, let's say you retire in the last 3-4 years and you put so much money on real estate, what will happen? So what am I trying to say is you need to diversify. Everybody put in the comment section, diversification. You need to diversify. You don't need to put your egg in one basket. Corporate tax trap. Cash sitting idles in corporation face up to 50% plus tax on investment income. And that's what I say. So when you make profit from your corporation, like, you pay yourself salary, you do everything. At the end of the year, you claim all the business eligible expenses, as spelled out by CRA. Your remaining profit, your profits at the end of the year, say for example, $100,000, $200,000, you reinvest that on, let's say, stocks, bonds, real estate. All right. You could pay as much as 50% on taxes. And that is why a lot of people are really facing crazy problem. Like, if you are a medical professionals or business owners, you must sit down and ask yourself, how can I keep more of what I am earning from taxes? These are serious problem. Why RRSP, TFSA, and investment alone are not enough? As of 2025, the maximum you can put on your TFSA is about $7,000. On RRSP is 18% of your earned income, up to about something $1,000. Now, if you rely on that, how much do you think you will actually put there that will give you enough retirement planning that you want in this country? So traditional wealth building tools have significant limitations for high income medical professionals. So market volatilities and contribution limits restrict true growth potential. If you put your money in stocks, bonds, or stocks, equity, right? You cannot really predict market, right? The market, you can't predict market. So, the market is subject to, up and down, up, down, and this is that is investment for you, right? But is it not wise enough to have another strategies that you can put your money that will be safe from that market volatility? Like, you put your money in a strategies that even if the market is down to zero, you still maintain your value, you still maintain the growth, right? Now, passive income inside corporation is heavily taxed, as I said earlier, right? When you make when you as a medical professionals or business owners, when you make money from your corporation, okay, you prepare your profit and loss, right? Your income, less salary, less other expenses, gas, whatever, at the end of the year, the profit before tax is, let's say, $100,000. Now, the profit after tax, let's say we pay 12% corporate tax. The remaining balance that is left into your corporation is what we call retained earning. If you invest that on other, let's say you put that on real estate, you make more than $50,000, you start paying 50% on taxes. That is the problem you are facing. Many doctors retire asset rich but cash flow poor. Now, there were, I think 2 weeks ago, I did a presentations on profit and cash flow. Do you know that profit does not really, mean that you have cash flow, right? Some people, they have so much profit on paper, but nothing to show in the bank account. So you have to balance the two, right? A lot of times, most people put a lot of money on asset, but they are struggling with cash. So you need to balance that, right? So one of the way to do that is to actually put your money in a tax efficient account that will not be, you don't tie your cash too much down. Because why? There are so many factors that could lead to that. It could be you are overtraining, could be mismatching. What I mean with mismatching is that you are incurring expenses, income in one month, but you don't match it up with the same expenses that same month. For example, in the month of November, right, where you make $20,000, but you don't account for what actually, what are the expenses that go with that $20,000. And you are carrying over one month expenses to another month expenses, and that becomes a problem. And at the end of the year, right, you see a lot of profit on paper, but it doesn't reflect in your bank account. And that's would threaten going concern. That is why many businesses die silently. So you, as a medical professionals and business owner, you must do a lot of, you have to sit down and analyze what you are doing. You don't leave everything to your accountant. Of course, you have your accountant that will help you to look into your bank account. But how many times have you actually sit down and audit your business yourself? Like, you look at numbers. Some of us are actually, there are so many leakages in your business that it's actually eating your money that you don't know. And that's why at the end of the year, right, people will make so much profit. I've seen many companies, they make so much profit, but they have nothing to show on paper. It's just on paper, it's not in your bank account. The power of tax sheltered growth. The power of tax sheltered growth. Life insurance transformed from a simple protection tool into a sophisticated wealth building vehicle. Like, it's many people have these misconceptions about life insurance that, oh, it's just about if I die, right? Of course, it's going to pay you that benefit, but look at it, right? Participating whole life and universal life insurance create tax deferred asset with guaranteed protection. So for whole life insurance policy, it actually guarantees you protection, and both guarantee protection, but the whole life is a kind of a form of guarantee cash value, right? Whatever you put there, once they run illustrations, that's what you're going to get at the end of the day, right? Tax shelter growth. Cash value accumulate and grows completely tax sheltered over time. Let me tell you this, right? If you put your money, if you have retained any, you put it on real estate, or you put it on stocks, or you put it on any form of investment, whatever you make on the growth, you're going to pay what you call passive income tax. And honestly speaking, you could pay up to 50% taxes. And that's why it's more crazy. Like it's crazy when it comes to passive income taxes. A lot of medical professionals have so much money sitting down in their corporation, but they don't know how to put it out. They don't know how to put this money to work, because why? They're afraid of the passive income taxes of about 50%. Imagine you make $100,000 profit and you are paying 50% of that back to CRA. So you make $50,000, you're paying 25, you are paying 50% of that. On the growth, right? Assess fund tax rate through policy loans or collateralized lending strategy. So now, instead of you to put that passive income, that retained earning on stock directly, right? You could actually put that one in a cash value life insurance policy and borrow against the cash value to go and buy your asset, to go and buy your real estate, to go and buy your stocks, to go and buy your bonds or whatever, whatever you want to do. It's like, it's just like you eat your cake and you still have it, because why? Your retained earning is still sitting down in that cash value strategies. You borrow against this to go and do whatever you want to do, right? Wealthy people use that, so you also should do it. The secret strategies for medical professionals, corporate owned life insurance. Number one, pay premium from retained earning. Use after tax corporate dollars strategically instead of leaving them exposed to passive income tax. So I'm going to explain this down very well so that you will understand what I'm trying to say here. The reason why you want to do this on your retained earning is because you want to save your money from the passive income tax of about 50%. Now, so there are various ways to do this. You can actually set it up on the corporation, but the best way to do this is to set it up on the holding company. So once you set up the holding company, it means that the retained earnings will fund the premium, right? So say, for example, you make $100,000 from your corporation as a retained earning, right? And you set up a holding company, right? Holding company is totally different from your medical corporation. So it's by default that, in practice, holding company does not really have any activities. Holding company is just a vehicle to invest the profit of the corporation. So whatever you make from the corporation, you put it on the holding company, right? So the holding companies will now be an investment hub of your corporation. Let's say, it's just an investment arms of the medical corporations or whatever businesses you are doing. Because why? As a medical professionals, you are not expected to do anything within your corporation if it is not medical. You are supposed to face that your medical practice, and that is why you want to put it on the holding company. The reason why you are paying the premium from the retained earning is because the growth on that strategies is tax free, as opposed to when you put this money on other form of investment like real estate. Don't get me wrong, I'm not saying that you should not put your money there, but this kind of investment, because of the risk of the fluctuations in the market right now. I remember people, I don't know how much. In my own case, I know how much I bought my house and I know the market value as of today. So if I'm a medical professional and I put so much money in real estate, okay, and suddenly the market just crash, I don't know what's going to happen. And I'm planning my retirement towards that time. That's what I'm saying, right? I'm not saying you should not put your money in real estate, but at least put it in an environment that, number one, that's not going to be subject to market volatility. Number two, that is going to be subject to heavy taxes, like, retained earnings. You make so much on retained earnings and you're paying 50% on the growth. So now if you put, say, $100,000 on your as a premium, okay, number one, the advantage is that you can borrow back against that premium to go and do your real estate. Now, number one, you agree with me that it is better to pay 4% interest than to pay 50% on taxes. If you agree, please type on the comment section, I agree. Let me explain this again. It is better to pay 4% interest than to pay 50% taxes. If you agree, put it on. I agree. It's a smarter strategy. So now you keep your retained earning, okay? And of course, you have access to that retained earning to go and buy your real estate, to go and buy stocks, to go and buy bonds, and whatever asset you want to do. Number two, accumulate tax sheltered growth. Build wealth inside a corporation with complete tax deferral on growth. Instead of you to pay tax on your retained earning, what you put there, let's say 10 years from now, right? That $100,000, $1 million actually grow to about $800,000, $900,000. That growth is tax free. So you can actually pull that money out, borrow that money, and use it for real estate or whatever asset you want to buy. Look, what we are trying to say here is that you are just trying to grow your wealth in a tax-free environment. Okay, in a tax-free environment. Everybody wants to save as much as money from taxes. There is nothing wrong in paying taxes. I'm repeating this, but if you have a legal way to save your money from taxes, it makes a lot of sense. Three, use capital dividend account, pass proceeds to tax-free to your estate through the capital dividend account, preserving maximum values for here. So now, if it is properly structured, if it's properly set up, all right, this money is actually go to the capital dividend account. The smart business owners and doctors, what they do is to create trust. So as the money is coming out from the capital dividend account, it actually go to the trust. And who is going to be the beneficiary of the trust, right? The family, whatever you put there, right? So it's just a very smart way to build wealth. Now, number one, look at it, right? Your premium that you put into the policy, you can borrow against this almost immediately if it is properly set up, depending on the carrier, depending on the way they set it up. Number two, the growth on the policy is also tax sheltered, right? As opposed to if you, let's say, for example, you put $1 million on real estate, you make maybe $500,000 gains, right? You're going to pay withholding taxes divided by 2, right? Less whatever adjusted cost is, whatever the cost of acquiring those assets, the gains on that you're going to pay taxes on of about 50%. Now, compared to the growth on a life insurance policy cash value that grow, right? Let's say you make $1 million, $800,000, that growth is tax deferred. You can actually borrow that cash value as well to go and buy your real estate. Okay, and when you pass, some medical professionals have a lot of assets. Imagine you have like 10 houses, like 10 real estate investment. You have both commercial real estate investment. You have so much money on maybe mutual funds or whatever, right? Don't forget that at death, all those assets will also trigger taxes. So you can actually use this one to take care of the taxes, right? Now, so from paying taxes to paying yourself, like you can also use this as a family bank concept. Number one, create your own family bank using policy cash value. So what, in fact, when as a medical professional, like ask yourself, what legacy do I want to pass to my family? You work so hard, and at the end of the day, you don't have anything to pass on, right? Think about it. You have these strategies. You make so much money in your lifetime. You put this on in these strategies, and you create a trust. Okay, what you are doing is that you're actually creating your own family bank. And when it's is a trust, you are giving instructions on how your money is going to be distributed according to your will when you pass. Let's say, for example, after 20 years, 30 years, right, the money grew to $10 million, $15 million, $20 million, depends on the way it is set up, right? This can be paid directly to the trust. And that trust, right, can continue to fund future trust. Like, you put instructions that every family members must have these strategies, and when they pass, they all put the money into the family bank, and that will continue to to replenish and do it to do whatever, fund your children education, go into real estate investment, go into other form of investment, do it go into so many things, right? Borrow against the policy, right? Access capital through collateral loans for opportunity. Like, that's what I'm saying, right? There are two things here, right? You can borrow against the premium, you can borrow against the cash value, depending on what you want, right? Depending on what your investment or your financial goals look like. When they are setting up, let them know what you really want to do, because many people don't want to put their money in a life insurance policy because I cannot wait for 5 years, I cannot wait for 7 years for me to be able to access my money. If it is properly set up, I can tell you from year 2, you should be able to start accessing money. Even from year 1, if it is properly set up, you can start accessing money almost immediately, right? Fund investment, deploy capital into clinic expansion, real estate, or other ventures. So now it's smart for you to put your money in a cash value strategies, borrow against that to go and buy real estate, to go and buy whatever you want to buy, and pay yourself pay yourself back with interest instead of enriching the bank. Imagine this, right? Let's say, for example, you pay $100,000 into a life insurance policy as annual premium, whatever amount you want to put there, right? Let's say the interest rate is 4% or 4.5%. Let's say you are paying $4,500 as interest annually on that policy. Do you know that you can also claim that from your income and expense? So that $4,500 is also an expense to the corporation. So instead of, let's say, for example, at the end of the year, you're supposed to pay corporate tax of $20,000, right? The $4,500 less of that one, the tax you're going to pay maybe around $15,000. Imagine that. Imagine that. So you claim this interest you pay on the money you borrowed from your cash value, and you still claim that in your corporation, from that will be written off to your profit and loss expense and profit and loss account. That is how smart people build wealth. Look at the case study of Dr. Aisha, right? Let's say at age 45, Dr. Aisha pay, at age 45, incorporated doctor pay $100,000 in taxes annually with limited growth strategies. So when this doctor shift the strategies, redirected $60,000 from traditional savings into a corporate life insurance policy, 10 years result, access up to $400,000 tax refund for clinic expansion while continuing to build wealth. Because why? You borrow against the cash value, you don't take the money out. It's just like you are eating your cake and you still have it, right? So you are not, so the insurance company will give you the money. Like, they are not pulling the money out from the strategies, right? The insurance company give you the money, not your money. So imagine the money is sitting down there, still continues to gain compound interest as much as they live. Estates receive about 1.5 million tax-free death benefits, securing a family future. This will be what will now translate to family bank, and that's the family can continue to use this same dollar smarter structure, right? So what you learned today: wealth system. Life insurance is not an expense; it's a comprehensive wealth building system. So think about it, right? Life insurance is not an expense. Many of us treat it as an expense. Let me also explain this, right? There are two ways to do that. I've just explained the retained earnings, right? If it is set up on the corporation, this is how it works, so that you also understand this. If it is set up on the corporation, all right, you make sure that the corporation is the payer, the corporation is the owner, the corporation is the beneficiary. Okay, now because the corporation is the payer, you are paying from the corporation. So at the end of the year, there's what we call add back. Your accountant will add whatever that need to be taxed, add back. They will add it back to your profit and loss, and they will tax it at the corporate. Let's say, for example, you pay $60,000 into a life insurance policy, but this time around is on a corporation, not on the holding company. There are two ways. There is a holding company, that is a corporation. So if it is on the corporation, so you pay 12% on taxes. Imagine that if you pay yourself salary, depending on your tax bracket, if you pay yourself salary of 60,000, you probably pay about 20 to 30%. But if you pay a premium of $60,000 on from the corporation, at the end of the year, you're still going to pay tax on that. Your corporation pay 12% tax. So they're going to, calculate that at 12%. So imagine that compared to 30%, compared to if you pay yourself salary of 30%. So that's how that's how it help you to save on taxes if it is on the corporation, right? There are two ways to do that. You see that you set it on the corporation or you set it on the holding company. Number two, tax advantage. Medical professionals can grow assets, tax sheltered, and protect assets efficiently. Now, see, if you understand the power of compounding and tax-free shelter, you will know that the only strategies that can give you this type of opportunity and advantage in this country is life insurance. I'm asking you, what kind of investment that can give you tax-free? You probably say TFSA. Of course, you already pay your tax before you invest the after-tax dollar. The growth is tax-free, but this one also carry a form of protection, right? So it's a very powerful strategies to build wealth. Strategic structure. The right structures that deliver lower taxes, more liquidity, and lasting legacy. If it is properly structured, If it is properly structured, okay, it help you to, so you can see there are two advantages to that. If it is set up on a corporation, you enjoy massive tax benefit, because why? The premium you pay there is going to enjoy the corporation tax bracket of, if it's Ontario here, let's say 12%, right? As opposed to if you pay yourself salary of $60,000. Think about it, right? Now, if it is on the holding company, right? If you invest your retain any directly on real estate, on stocks, you make gains of more than $50,000, you start paying about 50% taxes. But if it is put on life insurance policy on your holding company, the growth is tax sheltered. So it's a no-brainer. It's a very huge opportunity for you to save on taxes. Plus, you have access to your money almost immediately. So if you want to go into real estate, you want to do down payment from a commercial property, you put the money there, you borrow against this, you can do your down payment. And your money is sitting down there, gaining compound interest between 6 to 8% every year. And when you retire, you can still use it for retirement planning. No strategies can give you that one in this type of in this country. And that is why we're here to educate you on why you can save as much as you can on taxes. You know, I know one thing, right? Information is key. Many are struggling today. Many are actually looking in their eyes, their money, they just see the money coming in and the money is going out, and they're asking themselves, where is this money going to? At the end of the year, they make so much money and they're asking themselves, I don't even know how I even spend this money. It's not that you don't know, but what is actually eating your money is taxes and so many other things that you don't think that you don't take note of. So I just want you to know that tax is number one biggest wealth destroyer. If you don't know how to properly manage it, it's going to be extremely difficult for you to build wealth. You either pay tax or build wealth, never both. Okay, you just have to, and you cannot build wealth just by just investing and retain any. You must put up a strategies to do that. Your next step is to set up tax efficient wealth strategies. Review your structure, analyze your current corporate and personal financial structures for optimizations opportunities. So consult your insurance advisor, your financial planner to review I'm not here today to sell anything to you, but I just want you to open your eyes. If you have been doing it in a wrong way, right, just go back and sit down. How am I actually structuring my finances? Is very important, right? So ask them questions, right? What strategies am I actually using right now to build wealth, to also plan for my retirement? And I used to tell you this, right? As a medical professional, as a business owner, at least you must have at least 5 ways of building for your retirement plan. Number one, try as much as possible to pay yourself little salary. You never can say, right? Some people in this country today, right, what is actually saving them is what they actually pay themselves as a business owner. Pay yourself little salary, right? At the end of the month, you remit whatever that is need to be remitted to CRA. They match it up, whatever they want to match it up. That's one strategy. Number two, do a little bit of stocks, bonds, any form of investment. All right. Make sure to look at your risk tolerance before you do that. Consult your financial advisor before you implement that. Number three, do a little bit of real estate investment. It's very important. Do a little bit of real estate investment, right? When you are doing that, please make sure you consult with somebody who is very experienced in real estate market. Don't just go and meet those real estate that will just mislead you and make you lose a lot of money. They have them a lot, but we have very good one as well. And we also have a team of we have a real estate in our team. We have mortgage advisors, we have lawyers, we have CPAs that help you to do all of this if you need our services. So then the next one, please do a little bit of franchising. Or you can go into, and we have acquisition specialists as well that will help you to look into different businesses. I think recently we actually sent some couple of emails to some medical doctors in my list that, if you are interested in buying KFC, if you're interested in buying this, I'm not the one that is doing that. We have CPA that is doing that. They're going to look at your finances, check your numbers, if you are really qualified. And lastly, please do life insurance policy, cash value life insurance policy. If you have those 5 strategies in place, there is no way you have problem when you're retired, right? It's strategies. You just have to make sure that you sit down and design what actually work for you. Discover life insurance solutions tailored to your specific cash flows and wealth goal. Not It's not one size that fit them all. We'll just sit you down, look at your numbers, look at what is actually fits your situations, check your budget. If you're actually doing immediate financing arrangement, which are other strategies, I've mentioned that here before, but I'm going to still do a training there on that before the end of the year. Please check my LinkedIn and YouTube channels for updates. I'm going to still train on immediate financing arrangement and how medical professionals and business owners can actually use that to build wealth. Depending if it is immediate financing arrangement, of course you can do that on your only company. If it's a normal corporate life insurance policy, you can set it up on your corporation. It all depends on what you really want and your financial goal. But I do encourage you guys that please do it on your corporation. The reason why you want to do that on your corporation is, number one, you want to make sure that your money is saved from litigation. Okay, that's number one. Number two, this will also help you to build wealth outside your corporate practice. Let me tell you, a single case can actually consume your corporation if you are not careful. Yes. So you want to be smart enough to make sure that what you have labored for, court case, just one single litigation, just consume your corporation. So make sure you have a holding company. Please have a holding company. Start building something outside your corporation. It's a smart strategy. It's a smart way to build wealth. And work with licensed professionals to exceed your tax efficient wealth plan. So you have to work with licensed professionals, not just, and not everybody understand these strategies. Please make sure you ask them questions before you do this. This is not just anyhow strategies. It's a complicated and sophisticated strategies that need to take, you have to take note of so many things. My team, like if you want to do this, you have to make sure that you work with the accountant, you work with the lawyers, as well as the insurance advisor and the lender, all right? Because there are so many factors involved. There are so many parties that is involved in this. Make sure you work with them before you implement any solution. So thank you so much for joining, and thank you so much for listening to this presentation today. I just want to, if you have any question here, we can quickly look at it before we actually close our presentation tonight. Any question, please, if you have any question, you can drop it in the comment section so that we can quickly look into it. So if you're medical professionals, you're listening to me today and you are not sure, okay, you're struggling with your finances and you are looking to build a tax efficient way strategies, for retirement and all of that, please book a clarity call with me. It's free. I'm going to walk you through on how you can start it's never too late. If you delay it, it becomes a problem, right? Some medical professionals and business owners say, I'm going to attend to this tomorrow. Tomorrow becomes tomorrow, and before you know what is happening, time is running very fast. So you don't want to wait. Delay your retirement. 1 day, 2 days, it means a lot, right? Don't delay anything. Book a call, or you reach out to your financial advisor, insurance broker, and ask them question on how you can start planning for your retirement and start building wealth, right? So on behalf of Wealth Building Conference, I want to thank you so much for joining today. It has been a very fantastic session. So this month of November, we're coming up with another robust topics that will touch base on wealth buildings and how financial advisor can scale, right? Please follow me on LinkedIn and other social medias to get update on the different trainings and strategies on how to build wealth. But it's going to be massive before the end of the year, because why? We want to start 2026 in another way, right? We must build wealth. We must protect what you have. We must also preserve our assets. It's very important. So if you get value, I want you to put in the comment section value. If you get value for training today, please put in the comment section value. I really want to thank you so much thank you so much. All right. So on behalf of Wealth Building Conference teams, I want to thank you so much once again for joining. See you next week. Bye for now.